And what we're going to be discussing today is the near prime 40-year interest only 5/1 or 7/1 ARM. It can be done with full document or bank statement qualifying. So we look at it, what is the reason that you'd possibly use this program? Typically, it's going to be that there's some sort of a short-term scenario that the client has that would prohibit them from going with a standard mortgage. It could be that their income standards doesn't meet the traditional standards, or there might be a credit item on there that's prohibiting them also going from a standard guides. Their loans will go all the way up to over $1 million, so this can be used not only for conforming but for jumbo, and we'll go through and look at a lot of that as we go. So full documentation, you've got analysis. They're going to look at income driven from pay stubs. They're going to look at, you give them 30 days, signed 4506T, and a verbal verification of employment. Standard typical items for your wage earners. Other sources of income, and this is all within the guides, the DPAVER seller guidelines. This is going to be located, and I'll show you where, on the portal, but you can see all of the other types of income that they'll talk about. So if you have one type of income, you can look exactly at their spot, and it's an interactive guide, so it's very easy to go through. Borrowers that are self-employed, that own 25% or more of the business, we're going to look at a couple of different pieces. Sole proprietorship, they're going to look at federal tax returns for the last 2 years, a year-to-date profit and loss on the business. Notice that it doesn't state prepared by a CPA. They just need a current year-to-date profit and loss statement. And the sort of signed 4506. Why is my tab button not working? There we go. Partnerships, they're going to certainly need your federal returns. You're going to need your W-2s, the 1065, which is the partnership return, year-to-date profit and loss. I mean, all very simple information. Same with the corporate. If you've got corporate, you're going to also add the 1120s into it. If you have any K1s, you're going to add those into it. Pretty self-explained documentation, because it's the standard that you would find anywhere else for if you're doing a full documented loan. If you're looking at personal bank statements, there is either 12 months or 24 months. The borrower's got to have been self-employed for 2 years. The business has to have been in existence for at least 2 years. They've got to have a standard trade lines and a 12-month history. Housing history is required. Non-permanent resident aliens and foreign nationals are ineligible for the bank statement program. Statements must be consecutive and reflective of the most recent months available. So you need to go back from, if you're doing it this month, you've got to use last month through the last 12 or 24 months. They should show stable and even increase, because theoretically we earn more money as lifetime goes on. But if there's an evidence of decline in earnings, may result in a disqualification. Also, up to 3 NSF checks or overdrafts in the last 12 months are allowed with explanation. I guess I could have hit this all the way through. I'm sorry. Okay, for documentation requirements for the 12 and 24 month, the bank statements need to be from the same account. initial signed 1003 with the monthly income disclosed. So what they're going to do is they're going to look, you're going to need to put onto the 1003 up front, the borrowers are going to tell you how much income they make every month, right? They're going to look at that and compare it to the average of the 12 or 24-month bank statements, and they're going to use the lesser of the two. So if it were me, I would always tell the borrower, be sure to estimate high when you're giving me a number on your 1003, because if you estimated low in the bank statements, if you said, though, I make 10 grand a month and your bank statements come in at 12 a month, they're going to use the 10 grand. So it's not that we're trying to be manipulative, but you want to make sure that you just say, hey, be generous on when you're estimating, because they're going to just give you an estimate of what they made, and then we're going to average the bank statements. Multiple bank accounts may be used, but a combination of business and personal are prohibited. So you can't use partially business and partially personal. But if you have numerous business returns or accounts or numerous personal accounts, you can use those. 100% of the deposits are used for income, and they're averaged. Transfers between personal accounts should be excluded. So if you're moving money from one account to the other, it's a no-go. If you're going to use the two accounts because money comes in from one and another, you could use those. But transfers from a business account into a personal account are acceptable, because theoretically you're getting money from your business and you're putting it into your personal. Calculating the qualifying income, it's pretty simple. You're going to take all of the deposits, and then they're going to look at minus any disallowed deposits. You're going to need to make sure if it's unusual deposits that wouldn't match income, that's what they're going to look at. They're going to look at potential wire transfers of money coming in. They're going to look at money coming in from different sources. So that's where the disallowed will come in. And also, if you guys have any questions as we're going along, you can just hit the chat button and ask, just because I have everybody muted, so I'm not hearing if you're asking questions. And then, again, they're going to look at the income indicated on a signed initial 1003. So just be sure, as we've discussed, to watch that. Now, business bank statement documentation is a little different in that they allow the 24-month complete business bank statements. No transaction history printouts are acceptable. They have to have the statements. So if they have to go back to the bank and get those statements, it's all right. Just know that they're just going to have to get it, and you prepare them for that. And I always say setting the expectations appropriately makes your job very easy. They're getting this loan for a reason, and if you're just telling them exactly what they need, then there's no hassle to it. But it's when you come back and say, oh, no, I meant this. So I always just say it the way it is. Don't mince your words. You're the professional and the one that knows what's needed, so say it with authority and they'll get it for you, and you don't have to worry about it. Now, it does require that they're going to look at expense statements to determine, because of business accounts, if we look at a business account, what's happening is you've got deposits coming in from income, and then you have expenses. Now, let's say that they're a realtor, what is their expense going to be? It's primarily going to be advertising. It's going to be things of that nature. It's going to be more soft cost expenses rather than, let's say you've got a manufacturing company or a furniture company or a construction company they all have high cost of goods sold, meaning the cost of goods sold is what it takes to manufacture it or what the inventory is, so it has this higher factor that goes into making up the money. So when you see this, they're going to need to provide that information, and there's basically they're going to look at trends. They're going to look at negative ending balances. They're going to look at make sure that they're reasonable income and expenditures. So there's with business banks accounts. So let's look at from personal bank accounts, bank statements. There's no P&L required because they assume they know the expenditure's already been taken on the business side. But on a business one, they've allowed now 3 options in order to determine this. And every investor is going to require a P&L of some sort on a business bank accounts because you need to identify what the expenditures on are being occurred. So there's the first where you can just have your accountant provide you with the most current P&L that shows shows what the ending what their expenditures were, and they're going to look to make sure it's supported based on the bank statements. Second is that they're going to allow them to generate a business expense as a percentage of the gross annual sales or revenue. This would be, if I were doing it, I've put in a little example here. This is probably, I would go with probably number 2 or number 3 when it comes to the options. If you look at my example, let's say that they made $268,000 over the last 2 years. They had a 32%, which is 0.32, a 32% expense ratio. Probably pretty realistic for, say, a realtor. Okay, we're going to divide that by 24 months, which if you bring that down, you take that by the 32%. And I did this calculation based on how they said to do it. So you take that 268 times the 0.68, which is the 32% expense factor, which is 1 minus 32, which leaves 68%. It's saying 68% of the revenue is available to use as income, right? 32 minus 100% is 68%. So you take that, and then you're dividing that 68% by the 268. So you end up with 182,000. Divide it by the 24 months. You come up with $7,593. There's your monthly income. Pretty simple to work with. Now the nice thing with this is that on option 2, again, they're giving a percentage saying that the expenditures represented X percent of the revenue. Really easy way to do it. And then the borrower just provides a self-prepared P&L for it. So it's very simple for them to do. The third option is using it's called BizMinder, and basically it follows there's a national registry. Every company, every type of employment is put into a category. And then what they do is you would just pull the report from BizMinder, and it would say what the discretionary owner's earning is based on this industry code and geographic location. So it would basically give you what percentage of income should be earned in that business. Another easy way to do it. So it's saying rather than what is your expenses, it's saying what's left over, what's your discretionary income after expenses, and they do it in the form of a percentage. So doing it the same way that we did before, 268 by 68%, 24 months. 268 by 68% is 166, divided by 24 is 69.23. Again, a different way of coming to this through it, but I would probably, if it were me and I'm doing it, I'm going to probably look at 2 or 3 because I think that those are going to be easier and less expensive ways of generating this data needed for the loan. And this is why I don't animation to the situations. So here is the matrix, the new matrix from Deep Haven. It just basically gives all the data and we'll kind of break down the pieces. So if we look at the first section, we look at the max LTVs. You look at full documentation. This is, so when you're looking at these, you got to think everything is in overlays. So the first level you look at is, where am I sitting based on a full document? What can I get for an LTV based on FICOs, loan amounts, and what they're requiring for reserves? Second, it would be for bank statements. You can look and see what they're looking at. So if you're doing a full document loan or a bank statement loan, without any type of other features, these are what you would follow. But when we were going through it, we were going to look through and see if there's any credit hits that we need to look at. You know, that they'll say no mortgage lates in the last 12 months. Any type of foreclosure seasoning has to be in the last 36 months on this particular program. I'll remind everyone that we're only reviewing one of their programs. They have programs that will allow you to be 1 day out of foreclosure. It's a completely different program, but the guidelines still work the same way, and you can follow these matrices. So we're trying to give you one program, learn it, understand it. You can use it for any of their other programs. Bankruptcy seasoning, 36 months. Residual income, we'll talk about residual income. And then they just talk about the basic minimums. So now we go back, we go into other features. We can have potentially an expanded DTI anywhere from 4301 to 50% for full doc or 24 months. And we could theoretically go to 50% to 55% with full doc only, and it shows the loan to values go down and the credit scores go up, and they showed that the reserves go up and so do the residuals. So then you look at, okay, wait, if I'm going to do a 12-month bank statement, I can only go to an 80%, and I've got to have a 680, and then I got to follow the reserve and residuals based on the program. If I go to a 24-month, I can go to an 85% max. And now if I'm doing an interest only, 5-1 or 7-1, which is what we're talking about, the max I can go to is an 80%, and my FICO can be a 660. So things you always have to be looking at all the different overlays to make sure you're getting them right. All right, going into, then there's property types. If you've got single family, townhome, condominium, non-warrantables, you see the differences. Pretty much you're either 90, 85, or the rest are 80s. So pretty simple to follow right there. Okay, so this is the second part. So the first page of the guides look like this. It gives you just the grids. The second gives you some narrative to also go by appraisal review products, assets, cash out, compliance. I mean, we go through each. One of the things you'll look out for compliance, escrows is required on all loans. And you have to fully document while these are they're non-QM, but they are fully documented ability to repay. So you have to document the ability to repay, which we're showing with income. And the maximum amount of points that a borrower, points and fees, cannot be greater than 5%. So it's going to also follow the high cost standards. And then credit, they just state, standard 3 trade lines reporting for 12 months or 2 trade lines reporting for 24 months with activity in the last 12 months. We go into debt to income ratios, as we discussed. The maximum under the standard is 43%. However, you can potentially expand it all the way up to 55%, depending on your borrower. Income, we understand what we're looking at. And also understand they also have asset depletion options. So if your client has a large amount of money, you can theoretically do an asset depletion calculation and have more income there to use. So watch through that as you go through it, because if they have a lot of assets, you can certainly use that depletion to work from. It's ineligible in Alaska, Massachusetts, New York, or West Virginia. Primary and secondary homes only. They have a completely different program for investors. It's real aggressive. There's even one that doesn't even require that you put in income or assets. So take a look at that. That's an option as well. And then when we look at the ARM features, the margins are 3.5. The caps on the 5-1 is a 225, where the 7-1 is a 525, meaning it can adjust a maximum. The first year is the first available adjustment, says that's what the first number is. So on the 5-1, it's a 2. Then it can adjust annually 2% with a maximum of 5%. So that's why we have the 3 numbers. First adjustment every year after with a maximum of 5% cap. It follows a 1-year LIBOR. Currently, 1-year LIBOR is at 1.85. They have 2 different options. So under this one that we're looking at, on a 40-year amortization, what they're looking at is a 40-year loan. It's a 10-year interest only. Then it goes to a amortization, and it amortizes over 30 years after that. So it's 40 years in full maturity, but it's a 10-year interest only up front. So what would people look at? Well, I'm lowering my cost, and this is where it comes back to the thought: why is someone getting this loan? They have maybe some issues that they have short term, and secondly, they want to keep their cost basis going out short during that period while they're correcting it, and or they'll be moving on from the property in a short amount of time too. Maybe they're only going to be in the property for a couple of years, and then they know that they'll be moving somewhere else for whatever reason. We never determine what the client needs, but we're providing them options. So then we look at the last we talked about. They go back through and talk about property types, reserves, residuals, seller concessions. The seller can contribute up to 6% on the deals, and you can have an institutional second, an institutional only second, and a max combined loan to value of 90%. Now you'd have to have, being institutional, it needs to be probably like a bank, credit union, insurance companies that are offering. They've got to be a financial institution. They can't just be, a mortgage company offering a second mortgage. It can't be a community second. These types of things. So ratios. They do look at a front ratio and they look at a back ratio. If it's expanded, meaning that they qualified for those expanded ratios, they'll show that near prime, which is typically where we find things, is in the near prime. Non-prime, we start dropping down to lesser credit scores and issues, and then investment. Completely different animal, so we won't even get into that. So when you look at these expandeds, you can see what they have to do to have the expanded. It's got to have a greater than 700 score. It's got to be a loan amount less than 1.5 million. You've got to have 12 months reserves, full doc, or 24 months. No 12 months options. Rural properties are not allowed. And when they talk about rural, they mean I have to drive a great amount of distance to get basic services. It's not like you're just sitting outside of town and you're just driving in, you're within, a close distance to town. They mean that you're further out. So when you look at near prime, I'm not going to read through all of these. This PDF, and also I'm recording this, will be on the portal so you can go back and review the information. But it's here for you to go through, but we can look at all the different requirements for the 50% or the 55% under near prime. So Residual income. Residual income is your gross monthly income less your total obligations, and what's left over after that is your residual income. You hear that obviously with VA, and now you're hearing it with FHA, and so they want to make sure, the idea behind it is that you have X number of money left after everything's out the door. They want to make sure that you've got a specific amount. So if you take it, you say I've got 11.5 in income, my expenditures are 6,400, I have residual income of 5,100 after that's said and done into this example. So it says residual income of 15 is required under all non-prime programs, and 2,500 is required under the expanded and the prime. So that's 2,500 is typically what you're going to see. Plus, an additional 150 per dependent must be included for the programs. So you take that 2,500, and if you have one kid, you're going to be at 2,650. You got two kids, you're going to be at 2,800, and so on up the line. So that's residual income. Payment shock. The other thing that they want to look at is limited to 150%. However, it can go up to 250% if you have all of these other items right here that you have to meet to have it go above. So when you look at payment shock, basically it's saying how much greater is my proposed payment than what I pay in rent or mortgage right now. So if I have a proposed payment of $2,900 and I currently pay $2,200, you would go 2,900 divided by 2,200. That leaves 1.38 times 100. That leaves 131.8. So what that's saying, if you looked at it, is the 100. When you look at mathematics, 100 is always what you currently are at, right? So if 100 represented 2,200, and then you take 31.8% of that 131, that's saying that 2,900 is 31.8% greater than where I'm at right now. So if you were to take the 150%, obviously that's probably going to be around 31, right around 3,000 to 3,100 would be the maximum you would be able to go to if your present housing was 2,200. So it's pretty simple, but payment shock is always a factor when people are looking at any type of loan. They always look at payment shock, because if you're more than doubling what you're paying, that can be a harsh thing to overcome if you don't have other compensating factors. And that's what they consider to go to payment shock of 250%. They consider all of these things compensating factors: residual income, representative credit scores, debt to income ratios, housing ratios. All of those represent compensating factors. Adjustable interest rate and interest-only qualifying. So basically what they say is that you need to take for all ARM loans, you've got to take the fully indexed rate plus, which is the margin, plus the index is your fully indexed rate. And they said that you've got to take the note rate or the fully indexed rate, whichever is higher, to determine your PITI. On interest-only loans, you take the fully amortized payment with the fully indexed rate. So you would do your standard mortgage amortization payment calculation and say, I need to qualify with it over 30 years with the fully indexed rate, right up here, margin plus index, to come up with the payment, and that's what I'm going to qualify on. That's how they do that. So U.S. citizens are eligible for financing. Permanent resident aliens is a non-U.S. citizen authorized to work. They are eligible. Non-permanent resident aliens are not allowed under this program. They are under other programs that Deep Haven offers. So just remember that if you have one of those, you need to look at their matrix and see which one offers they have a foreign and national, which falls under the investor program, and they also have ones that fit for non permanent residents. The non-permanent residents, they're ineligible for the expanded near prime bank statement or investor adage. They're not available for them. For residency status, these are the statuses that they look at. Again, they have all these other products that are available for them, so remember that they're there and they offer a lot of different choices. So on the portal, under loan officer support, you'd click down, it drops down, and the first one is going to be, actually I think it's the second one is Resource Center. The first one is new loan officer. The second one is Resource Center. Resource Center, you come down right below topics, and you have Deep Haven loans right at the bottom of that section. If you click on that, it'll take you to that section. And what you'll have is the matrix, the Deep Haven seller guide, a PowerPoint, and the contact for the scenario desk. So if we looked at the matrix, here's what the matrix looks like. You can go through, here's expanded, here's near prime, here's non-prime. And when you look at non-prime, I wanted to see if it showed which one. I believe that it's the non-prime that allows for other things with regards to that they'll allow for non-permanent resident aliens is under the non-prime. And then you get into the investor matrix, which talks about if you got an investment or foreign national, this is who you're going to follow under. So it's nice and easily grid out to work with. And then the seller guide, this is what I like about it. So when you come into it, you see you've got your table of contents. Anything that you wanted to find programs, it'll immediately pull up your programs. And let's say that I'm looking for a bank statement program, and I'm going to use personal bank statements. If you just click on that, it immediately takes you into what you need. There's no scrolling through, and you always can just go right back to, I just clicked this very easily just to go back to it, and I come back in and I can find what other pieces I'm needing. It talks about a lot of different things. If you've got verification of assets that you need to go through, if you've got specific assets that you need to look at, for example, spousal accounts, you can come right in and it'll talk about it, and you know exactly what you need to do. And then it'll have separate sections. It'll say asset documentation. It'll say, okay, what do I need to get? Well, I need to make sure that the statement provides the borrower's account number, their name, the statement date and time period it covered, and the current balance in U.S. dollars. I mean, so it's just saying it's very simple to work through this guide. The credit policy is written based on this. This guide just came out, so our system within our credit policy isn't up to date because this came out 11/6. They had just released it, and I had talked with them by chance that day, and they sent it over to me. So our credit policy isn't up to date to this. It will be adjusted, but understand that this is on the portal for you to look at. So Deep Haven Scenario Desk, they are awesome to work with. They will go through and help you with anything you need. I would recommend calling them over me because it's their product that they deal with every day. They just have all the information you need. You can call them or you can email them. The only thing that they don't do is calculate income off the bank statements. Our underwriting department will assist you with that if you need help. A lot of times you just need to validate whether a specific deposit is acceptable or not to determining averaging your 12 or 24 months on that. But full document is pretty much self-explanatory. So they're not tough products to work with. The key is just knowing, I say this all the time, any product that you're not using every day, you should pull the guides and have them with you and just review them, because once you review them, you go, oh, this is simple and it's easy to use. And when you know these guides, like the investor portion, I would be out selling the investor loans, because you can go in and buy as many properties as you want. They're very easy to work with. Yeah, the rates are a little higher, but if you've got people that are, they're just trying to acquire real estate and maybe they don't have enough qualifying income, but they can work with it because they've got rental income off of the property, a great thing to work with. I'm not telling you guys what to do, but there's options out there to be out meeting with realtors and getting buyers coming your way. So that's the end of it. I'm going to open it up for any questions that you might have. Please let me know.
Okay, you're in it. That way I can get